Hello, this is Stephen Harris, a head trader from Falcon Global, where we model best practices for investors, traders, and day traders from entry to exit every trading day. In this daily video, I'll provide my opinion and insights of current market trends, market timing, volatility, and hedge risk levels for the upcoming day for the key U.S. financial markets. It is 6:51 a.m. Central Time, and I'm recording this in preparation for the market day of November the 2nd, 2015. Full disclaimers are at the end of the video, but be aware that this is for educational purposes only, and only you are responsible for the investing or trading decisions that you make. So let's go ahead and dive into the morning report. And on all four broad market U.S. indices, they're essentially scratched with nothing really to note. Crude oil, though, is quite different. It's down 1.65%. Euro is scratch. Bonds are down about a third, and gold is down about 0.4. In overseas action, China's down about 1.7%, Hong Kong down about 1.2%, Japan down about 2.1%, Germany going the opposite direction, it's up almost 1%, United Kingdom's down about a third of a percent. In terms of macroeconomic reports for today in the U.S., you have ISM manufacturing PMI, and you have FOMC member Williams speaking. And that's about it for the U.S. In terms of tomorrow, in our look ahead, you have factory orders. And that's about it of any real note. In terms of current volatility conditions, you have short-term VIX at a 14.31, so nothing particularly alarming there. Skew still remains elevated. This is going into the third week now where we've had elevated skew ratings, though this is not as high as we've seen recently. IV percentiles very low, 12 in the S&P, 19 on the Russell, 15 on the NASDAQ, and 19 on the Dow. No standard deviation moves were put in by any of the four broad market indices on Friday. So a little bit quieter there, and not too much to make out of current volatility levels. In terms of our regular daily report, we are still phase 3 bull flag is the expectation. In fact, let's go ahead and drop over to the charts. You see on the SPX, we've come back into this prior range that was so pronounced for so long. We did have a 3-day pattern with a big up candle, a doji, and then confirmation of that reversal pattern back down on Friday. Now we have to wait and see where that goes today and into the beginning of this week. But right now, you'd have to say short-term bearish pattern, but that is in, as we said from the daily report, a bull flag kind of expectation. So much like you've seen here, where you run up, run into some resistance, bull flag, then up, bull flag, then up, bull flag, then up. We would expect this to be a relatively shallow pullback, and then a continuation of the bull flag, bullish continuation pattern up until at least we get to this resistance area of the former all-time highs. Now, at that point, that would be quite interesting. So, while this may indeed pull back deeper than some of these other pullbacks, and we've of course gone some 220 odd points from this low to the top, that we would have maybe even a 1/3 retracement and go deeper, wouldn't be totally shocking, but probably the most likely scenario is that a shallow pullback of a couple, 3 days, and then continuation pattern higher. In terms of the Dow, very similar pattern to what you have with the S&Ps. And again, a very similar 3-day pattern. Bull flag kind of pattern is the setup. And we'll look to see where that follows through. The Russell, of course, has been the weakest and hasn't come to regain its former range at all. It is much, much further back. While it did have some very bullish action on this day, and I believe that was a 3 standard deviation move, you see we're just right now into the cloud, and in the cloud is trendless. And So this action here is expected to be, somewhat um, uh, difficult to predict which direction that is likely to go. Certainly, compared to the others, it is clearly weaker. Now, one that is not weaker is the NASDAQ, and it's been powered by a number of its primary components like Amazon and Google on the back of very good earnings reports, and it is on the verge of all-time highs. So very, very, very close. And we'll see if they can break out of that consolidation pattern after that gap and go. Okay, let's take a look at the VIX futures real quick while we're here. And you see we have broken down into that area below an 18. So this is kind of a bull trend kind of volatility pattern where the volatility is in that area between 12 and 18. We certainly haven't gotten to the lower thresholds of 12, 13 yet, but certainly we're well under the 18 threshold, where we kind of think of it as above 18 is primarily bearish for the market. Back to the daily report. In terms of portfolio investor postures, not a lot of change here. IBD status remains confirmed uptrend. Accumulation distribution score on the S&P is a B. NASDAQ a C. So a bit weaker from that standpoint. Remember, while the NASDAQ is relatively strongest, it's on the back of a handful of components and doesn't yet have broad-based support. And that's part of the reason why you see that more of a warning status in terms of the accumulation distribution pattern on the NASDAQ. GMI index is a perfect 6 out of 6 and had a buy signal since 1019, though that author remains in cash until the 10-week moving average overtakes the 30-week moving average. Primary market condition is still a neutral bear. And indeed, much as this GMI author is referring to, if you look at the relationship of the key moving averages, we're still in something of a bearish condition. In terms of decision points, we continue to be mixed with short-term across the board and a bullish stance in the intermediate term, mixed signals, and in the long term, bearish signals. So very difficult when you have this kind of twisted set of time frames. Much easier to prognosticate and forecast on your chart when you have all three time frames all lined up and stacked. And when you're not stacked, you got to take that as something of a warning sign. Consensus, when you put all this together with the intermediate term market posture, is that we are remaining in something of a transition, and it remains yet to be seen whether we can establish new all-time highs and we start to move into more of a stacked pattern and more of a all bull all the time kind of expectation versus this kind of mixed and twisted pattern that we're currently finding ourselves in. This twisted pattern, if the long term rules, and usually that is the most powerful pattern, well, then the expectation is that these recent rallies will fail and that we would go down and make new lows. So that's why you can't take too much for granted that you know that we're in a long-term bull pattern. We're not. You are not confirmed to be able to have everything lined up. In terms of intermediate term, your market posture there is very bullish, and an upslope sentiment. Indeed, if you look at the individual components, S&P, Dow, NASDAQ, all very bullish. Russell also bullish, though weaker in a relative sense. In terms of position sizing opinions, they both remain at 100%. In terms of hedge warning status, remained at 0+, which is normal with elevated risk aspects. And that will remain at that 0+ until we see probably all-time highs and we have our time frames all kind of stacked and lined up. In terms of the monthly portfolio risk opinion, we do have an update here. I completed most of my monthly review of the business cycle analysis over the weekend and ran this set of calculations again, and it's calling for upside at 3% out of the money on the call hedge and 2% out of the money on the put hedge with a 1 call to 1 put ratio. So absent new developments, the potential for a severe correction are currently neutral. In terms of specific volatility metrics, some of these have ebbed off, and really the only thing that's left is the fact that we have a distribution day count of 5 on the S&P. If that gets much higher, it could call that IBD status of confirmed uptrend into question. You see the skew is also still elevated and currently has about a 9% probability of a 2 standard deviation move within the next 30 days. Expected move this week is about 31 points, so a tad bit higher than last week. Nothing really extraordinary there, though. In terms of New York Stock Exchange, new highs, new lows, we ran almost 3 to 1, certainly over 2.5 to 1 in terms of the number of new highs, but it was not over 300, so it wasn't particularly exciting on Friday. On the intermarket risk aversion indicators, all 5 are solidly risk on. Special opinions, option income strategies, the VIX is inside the acceptable window, so it is acceptable to initiate new option income strategies even for novices. Cover call strategies and put selling, we'll go ahead and merge the two of these together for today. There's not much change here. Cautiously bullish, acceptable to initiate new positions. In terms of cover calls, think about a 1-to-1 ratio of out of the money and in the money strikes. Also a 1-to-1 ratio of higher beta versus lower beta positions. On those more aggressive setups, whether you're looking to come into a cover call position or you're just selling puts, consider legging into those, building the full position, or also that you might spread them off and at the very least reduce your buying power, but also reduce risk. If we should indeed see that that long-term posture is the one that rules and we do roll down, you want to always make sure that you are scaling this in a position size that you are willing to own. In terms of sector specific, you see it's pretty much green across all 3 time frames and almost all the sectors. Transportation is a little bit weaker, consumer staples a little bit weaker. Utilities, of course, has been showing some weakness with the anticipation of interest rate changes, and retail has been healing from the pummeling it took with the recent Walmart news, but it certainly is looking better. In terms of sector specific percent change, you see it was a pretty mixed day on Friday. Energy actually was up the most, followed by utilities, and yet at the same time financials was at the bottom, and usually if you think of a good strong bull market, the financial sector is absolutely essential to participate in that. So just kind of pull some of this together. You think about what do you need as the characteristics of a strong bull market. Well, you need things like energy to do well. Well, check, we did that on Friday. But you need financials to do well. That did not happen. Information technology probably would also be one of those high beta leaders. Also did not do well on Friday. You look for the Russell to be, with its small cap growth oriented components to be doing well. And certainly it has done better of recent, but it is clearly much relatively weaker than the other indices. You look for the NASDAQ to do well. Well, it is doing well, but it is not doing well from a breadth standpoint. It's a handful of major components that are driving that index, and we'd like to see broader participation by the various components in that index. So there are some very, very good signs, and we have to be bullish because clearly when you've gone 220 points from the bottom to the top, and let's make a note about this, this occurred in about a 5-week period, and that move was about the largest move in that period of time in the last 4 years. And you think about how much bullish activity we've had in the last 4 years, that's just how big this move is. So let's not minimize that. That is huge, and it has brought us all the way back into this former range. But at the same time, there are clear signals of problems with calling this a strong bull market, at least on the longer term time frame. So keep some caution, some defensive aspect to your trading and investing activities until that situation resolves itself. Either way, and you have more clarity as to what's going on with your investing and trading forecast. So that's probably enough for today. If you find this is helpful to your trading, we would greatly appreciate you showing that by liking us on YouTube, subscribing to us on the YouTube channel. We're on the verge of hitting 100 subscribers, which is a pretty remarkable thing in the amount of time that we have been doing this. So definitely growing there. A lot of people finding us, and they find us because of the things that you do and that you share what we're doing with your trader community and friends. And you can do that also by retweeting us to your Twitter followers, to your StockTwit followers, etc. Direct email support can come to support@falconglobaltraders.com. Couple of special offerings out there. More information about this active money management course can be found at this website. And this can be done by both people who live in the greater Schaumburg, Chicago area, or virtual. There will be a simulcast. And then also, this website gives you more information about what we do at Falcon and how we actually apply these principles that we talk about each morning. And then the disclaimers, as always. Hit the pause button if you need more time to review the disclaimers. And we'll see you back here tomorrow morning for the market preview from Falcon Global. Good trading.